Hello everyone and welcome to this week's episode of Kickstart Your Real Estate Investing. In this week's episode, we're going to take another financial metrics which is called cap rate or capitalization rate. This metric is very widely used in multifamilies and also evaluating commercial real estate deals. So it's important to understand how it works and where you can use that. Okay. So in a simplest of term, cap rate indicates the rate of return you can make from an investment. Okay. So let's take an example. So let's assume you're investing $100,000 in cash to buy a particular investment property. And you find out that the cap rate for that is 10%. So what that means is that you would make $10,000 in net operating income from that investment of $100,000. So the rate of return which you get from that investment is then called as a cap rate for you. Now, if you take from a formula perspective, it's a very simple formula. What a cap rate indicates is that if you take the net operating income and you divide that by the sales price of that investment, you can get the cap rate. So in this example, if you see that you got an NOI of $10,000 and then you divide that $10,000 with the price of the asset, in this case is $100,000, so your cap rate is 10%. Now, conversely, if you got $20,000 as NOI and your sale price is still $100,000, then your cap rate in this case will be 20%. And in the same way, if you got $5,000 as your NOI for a price of $100,000, in this case, your cap rate becomes 5%. Now, how do you know what the cap rate is? Now, if you were to go and evaluate a particular property and say, hey, if I want to find out what is the right price to pay for this property, how do I go about it? You can find the NOI from that particular seller, and the seller will tell you, okay, the net operating income for this particular asset was $10,000. And now you can say, okay, so I know what the net operating income is, and I can find out what the cap rate is in the market. Now, then that will help me decide what the sale price I should pay for this, because it's the same equation, it's just turned around a little bit. So to find the sales price, what you will do is you will take the NOI and then you divide it by the cap rate. So in this case, your NOI is $10,000 and the cap rate is something you can find out through your real estate investment community. You can find it out from your realtor. You can find it out by looking online and finding it. But the whole idea here is that the cap rate for a particular asset class or for an asset is based on what has been sold in the market for those particular assets. Okay, so it's more like a comparable sales approach which is used here. So if you take this example and say, hey, I'm buying an investment property where there's a single tenant, which is Starbucks. Okay, then you can go and look in the last 6 months or a year, how many such properties were sold which had Starbucks in it. And you will find out that, okay, a property which has a Starbucks in it is a 5 cap property because it's a lower risk. So it's a 5 cap property, right? So now when you get a particular cap rate, you can take the NOI, which was $10,000 in this case, and let's assume your cap rate you find out is 5%, then you can very quickly figure out that the sales price for this will be $200,000, right? Because you take $10,000, you divide it by 5% and you get the sales price. So you would know what would be a good fair market sales price for that particular investment opportunity. Okay. So one thing which you have to remember is that a cap rate is very strongly correlated with the risk, which is the perceived risk for that particular investment. Okay. So if you buy a very riskier property, your cap rate is going to be higher because you will demand a higher return for taking on more risk for that particular investment property. If your cap rate is lower, let's say in this case, you had instead of $10,000 of NOI, you're getting $5,000 of NOI for the same $100,000 you're investing. So your cap rate is 5%. So that would also translate to that maybe this investment is of a lower risk. So lower the risk, you get lower the return. Okay, it's more stable return, but it's the lower the return. So when you go and start looking at value add properties, the buyers in this case are really looking for a higher cap rate because they're taking on more risk to take a value add property, bring it to the right value, stabilize it, and then sell it off at a lower cap rate where they can make more money. Okay, so how does this work? So another way to look at a cap rate is by looking at a concept called as a NOI multiplier. So how does the NOI multiplier work? It's again a very simple formula. What you're doing here is you're taking 1 divided by the cap rate. Okay, so that will give you a multiplier for the NOI. So let me take this example, right? Let's assume the cap rate is 10%. So 1 divided by 10% is going to give you 10, right? So now you know your NOI multiplier is 10x, right? So let's assume your NOI in this case is $10,000. So your 10x multiplier for that will make it to $100,000. So now you know your sales price is going to be 100,000 because your multiplier is 10x of the NOI. Let's take the same example. Let's assume you find out that your cap rate is 5%. Okay, so in this case, what is the NOI multiplier? 1 divided by 5%, which is equal to 20. So the same $10,000 of NOI with a 20x NOI multiplier will give you $200,000. So this way, when you look at from a point of view of an NOI multiplier, you can very easily see where the buyers are coming from and where the seller is coming from. If I'm the seller, I want the NOI multiplier to be higher, right? Because I get 20x of that particular NOI which is there. If I'm on the buyer seat, I want to make sure the cap rate is at a higher level. That would mean my NOI multiplier is going to be lower, right? Because if it's a 10% cap rate, my NOI multiplier is 10x. If it's a 5% cap rate, my NOI multiplier is 20x. And that is basically what goes in when you start looking at from a value-add investment process, right? The person who's buying a value-add asset is buying a property with a very lower NOI multiplier. Let's say 10% cap rate is a 10x NOI multiplier. They increase the NOI, okay, and then they want to commit at a lower cap rate. A lower cap rate would mean a higher multiplier. So let's say take an example, right? Let's assume you buy something at a 10% cap rate, which is a 10x NOI multiplier, and you're able to bring it up to an 8% cap rate, which is a 12.5x multiplier. So for the same NOI which is there, if you are able to reduce the risk there and increase your cap rate in that manner, your NOI multiplier goes up. Okay, so that way you can look at a cap rate in two ways. One is for the rate of return based on the risk, which is risk profile of that investment. And second is from an NOI multiplier perspective is for a given NOI, what kind of multiplier I would use, which is based on the cap rate. Okay, so hope this was helpful to you. And if you like this episode, please go ahead and like and subscribe to my channel. Thank you.